Have you ever seen a stock take a dramatic nosedive and immediately think, finally, a bargain?
Oh, yeah. It's classic investor thinking, right?
Totally. Well, today we're taking a deep dive into a company that did exactly that, Supermicrocomputer, SMCI, the AI hardware darling.
The one that soared past, was it $1,200?
Exactly, and then just tumbled back to earth. But here's where it gets really interesting. Even after that spectacular fall, our sources are saying it's still, well, fairly priced.
Right. And fair in stock market terms can be super frustrating.
It really can.
Yeah.
Because it leaves you wondering, okay, so what do I do with that?
Exactly. So our mission today is to unpack precisely why SMCI isn't seen as a screaming bargain,
Yeah.
Or some kind of inflated bubble.
But just sits in that meh, maybe zone.
Right. We've synthesized articles, research, expert analyses, specifically digging into a recent piece called Supermicrocomputer. Still fairly priced, even after its big crash, to pull out the key nuggets for you.
So we're going on that journey.
Yeah, we'll cover the whole arc, from its meteoric rise early 2024, fueled by those dreams of endless AI demand.
And their unique tech, right? Liquid cooling.
Their ability to deliver cutting-edge, liquid-cooled GPU servers and do it at scale, all the way through to the humbling fall.
Caused by some serious red flags.
Serious stuff, like an auditor bailing, delays in filings, those Hindenburg short seller attacks, even Justice Department investigations popping up.
Wow.
Yeah, the stock definitely collapsed. But the takeaway from what we've read is it came back to earth, not down to some absurdly low level, just fair.
That sets the stage perfectly. A wild ride indeed. So let's peel back those layers. First, that explosive growth phase. What made it the golden child of AI infrastructure? What really propelled SMCI to those, incredible heights early in 2024?
Well, what's fascinating here, according to the sources, is that SMCI wasn't just riding the AI wave. They were uniquely positioned.
How so?
It comes down to their ability to quickly deliver customized servers, often liquid-cooled GPU servers. And that's not just a technical spec.
It's an operational advantage.
Exactly. AI chips get hotter, denser. Traditional air cooling struggles. SMCI, they'd invested in liquid cooling tech and, importantly, the manufacturing agility years before. That put them ahead.
So they were ready when the demand hit.
Right. And it let them land these massive contracts. We're talking Tesla, XAI, CoreWeave. They became the go-to for specific high-demand AI builds.
Okay, so fast, agile, specialized tech, like liquid cooling that others were scrambling to catch up on. Sounds like a powerful mix.
It was.
But then, like you said, the narrative shifted dramatically. What were those brutal reality checks that sent the stock tumbling back?
It really was a perfect storm of red flags. Probably the biggest one.
Yeah.
The auditor exiting in October 2024.
Yeah, that's never good.
Never. Followed by delayed financial filings. For investors, an auditor bailing is like, seeing smoke pour out of an engine.
Right. It immediately makes you question everything. Financial integrity, transparency.
Totally. Then came the Hindenburg short seller attacks.
Yeah.
They basically amplified those concerns,
Right.
publicly detailing alleged accounting issues, governance problems.
Adding fuel to the fire.
Big time. And then, to top it off, reports surfaced about Justice Department investigations into past practices.
Oof.
Yeah. So all of that together creates what the analysts call a governance overhang. Basically, the uncertainty and potential fallout from all these legal and accounting things just keeps weighing on investor confidence. It makes it hard to trust the numbers, even with the impressive growth.
That is a lot for one company to handle.
Yeah.
So you've got this incredible growth story driven by AI. And on the other hand, these really serious governance issues. Now, as we dug into the numbers, that revenue growth is incredible. I mean, truly jaw-dropping.
It really is.
But then something else jumped out, something that could be Supermicro's, its real Achilles heel. What were we seeing there with the gross margins?
Yeah. It's that classic good news, bad news situation. The revenue growth is, like you said, spectacular, nearly doubling. Think about that, from about $7 billion in fiscal 23 to an expected $15 billion in FY24.
Wow.
And on pace for maybe $22 billion in FY25. Those are hyper-growth numbers, no question.
Right.
But the Achilles heel, as you put it, is those plummeting gross margins. That's the profit on each sale, right?
Okay.
Before operating costs.
And they're shrinking.
Expected to shrink down into single digits.
Which is it.
Yeah. It's critical because it shows that while they're selling a lot, they're making less profit on each thing they sell.
Why is that happening?
Well, it points to a lack of a wide moat. Think about NVIDIA. They have this deep technological lead, this ecosystem. It's incredibly hard for competitors to just copy them.
SMCI doesn't have that same kind of protection.
Not really, no.
Yeah.
Not in the same way.
Yeah.
Dell, HPE, these are massive players, right? They're catching up fast in server tech, including liquid cooling. It's turning the server market into more of a commoditized space. More competition means less pricing power.
Okay, so revenue's exploding, but the actual profit per sale is shrinking, partly because the big guys, Dell and HPE, are now right there in the mix.
Exactly.
Which brings us back to that central idea. Fairly priced. Given all this, the growth, the governance issues, the margin pressure, what does that 28x forward PE really tell us, especially when you compare it to, say, NVIDIA or just the average tech stock?
Right, so all these factors kind of swirl together and result in that fairly priced label, trading around 28 times forward earnings.
Meaning what they expect to earn next year?
Correct. Investors are paying 28 times next year's expected profits. Now, that's cheaper than, say, NVIDIA, which trades at a much higher multiple, but it's still more expensive than the average tech stock, which is maybe around 22x.
Let's stuck in the middle.
Kind of. And what that price implies, the 28x, is that the market is basically baking in absolute perfection from SMCI going forward. Well, yeah. It's priced for continued big growth, sure, but growth without any hiccups. No more governance issues, stabilizing margins, successfully fighting off Dell and HPE. Flawless execution, essentially.
But, I mean, given SMCI's recent history of hiccups, the auditor, the short sellers, the DOJ stuff, is that really a reasonable expectation? Is the market maybe being a bit too optimistic, demanding flawless execution here?
That's the million-dollar question, isn't it? And it's exactly why analysts are all over the map with their price targets. You see some down to the $30, like Goldman Sachs reportedly had a $32 target.
Wow, that low?
Yeah. And then others looking at $70, $80 and those dreaming of triple digits. That requires, absolute perfection, like you said.
So if things don't go perfectly, if margins keep shrinking or they lose a big customer,
then that fair price could start looking pretty expensive pretty quickly. The risks are clear, right? We've talked about margin compression. There's customer concentration. Apparently, 2 clients make up over half their revenue.
That's a huge risk for a hardware company.
It is. If one of those shifts strategy, ouch, then there's the fierce competition. And that governance overhang we mentioned hasn't completely gone away.
Okay, so that's the downside picture. Pretty stark. What about the potential catalyst? Is there anything that could push it higher despite all these challenges?
Oh, absolutely.
Yeah.
The biggest one is just the continued AI boom. If demand stays this incredibly strong, that's a massive tailwind for anyone making the servers.
Okay.
And their product leadership in liquid cooling, while it's being challenged, it's still a current differentiator. They are good at it.
And the big contracts?
Yeah, they've secured some huge ones, like that reported $20 billion Datavolt partnership. If they execute well on deals like that, it could significantly boost revenue.
So lots of potential, but lots of risk.
Exactly. Ultimately, Supermicro is what analysts call a show-me story. Investors basically need proof.
Proof of what?
Proof that margins can stabilize, proof that competition won't just eat their lunch, and proof that those accounting scandals are truly, truly history. Until they demonstrate all that, it seems stuck in this kind of fairly priced holding pattern.
Okay, let's just quickly recap this wild ride. We've journeyed through Supermicro being the golden child of AI servers, hitting over $1,200 a share.
Riding high on that fast delivery, custom builds, liquid cooling.
Right, landing deals with Tesla, XAI, CoreWeave. Then we navigated the brutal reality checks, auditor exits, short seller attacks, legal investigations, sending the stock tumbling. We explored how that spectacular revenue growth, nearly doubling year over year, heading towards maybe $22 billion, is overshadowed by that Achilles heel.
The plummeting gross margins, expected to hit single digits.
Yeah, and that lack of a wide moat, unlike NVIDIA with Dell and HPE catching up fast, it really sets it apart.
And that's how all these pieces, the good and the bad, seem to culminate in that fairly priced valuation around 28x forward PE.
Cheaper than NVIDIA, pricier than average tech.
Right. Priced for big growth, but with zero room for error. Which is why analyst targets are so spread out from the 30-daters up towards $80 or more, needing flawless execution for those higher numbers.
We looked at the clear risks, margin pressure, customer concentration, competition, the governance stuff.
But also the potential catalysts. The ongoing AI boom, their current edge in liquid cooling, those massive contracts like Datavolt. It really is a show-me story. Investors are waiting for proof. Proof margins can hold up, proof they can fight off competition, proof the accounting issues are gone for good.
So what does this all mean for you listening? When you see a company like SMCI with this incredible growth story side by side with these frankly dramatic risks, and it settles into this fairly priced zone. It's not a screaming buy, it's not an obvious short. It presents a unique challenge, doesn't it?
It really does.
It kind of reminds me of, looking at a used car. It's not obviously a lemon, but it's definitely not a steal either. It's just fair. And you have to ask yourself, does that fair price really account for the potential maintenance down the road? Or in SMCI's case, the cost of fending off really aggressive competitors.
And it raises a really important question for all of us navigating these markets today, I think. How do we actually assess value? Not just based on a stock's past, wild ride or even just its future projections alone, but based on its current very precarious balance between potential glory on one side and potential disappointment on the other.
Yeah.
What does fairly priced truly tell you about a company's underlying health, about its actual path forward in an industry that's changing so incredibly fast? Especially when success seems to hinge on navigating such specific, intense pressures like margin compression and huge competitors breathing down its neck.
It's a fascinating perspective. We really encourage you to consider this knife's edge view. What parts of SMCI's story resonate most with your own understanding of how markets work? And maybe more importantly, how do you evaluate a company that sits so squarely in that challenging show me category?